Hi guys, Darko here. It's time for a new video. I often get questions about the order flow, how I use it to add confluences to my trading. So I thought, let me make this video to clear that up and you guys can know how I use it. So don't waste any more time and let's get into it. So first of all, what is really important is to know that I use this only for confluence. Oftentimes people want to use all kind of indicators and add stuff to their trading arsenal, but it's important to first focus on the basic and then get into some other stuff. So only use this as confluence and don't let this be a leading indicator. That's very important, so I first want to make that clear. Now let's get into the data. For this data I use ExoCharts. Also have other platforms like Velo and stuff, but I really like ExoCharts, so this is why I'm using it. You can find it and then you can add the template. Basically all I use is the open interest and the CVDs. So let me quickly explain to you what the differences between those is. First let's get into the CVDs. That's the box down here. It basically shows the cumulative buying and selling of the perps, which is the orange one you can see here, and the white line represents the spot buying. Basically how I use it is to look for divergences between the two. So look where the one is going up and the other is going down. And then I like to use a stamp of rule, like the white line is spot CVD. So that's like spot buying. That's in my opinion always that's the real and genuine buying. So white is the genuine buying and the orange one is the perpetuals. So that's like futures, and that's with lend money. So people use leverage and then eventually they have to pay that back. So that are more vulnerable positions. So I always want to add more importance to the spot, which is white, and then look for divergences. For example, if spot is buying and perps are not buying, then that's a strong sign because then you have genuine buying. That is what we can see here. Spot was buying, price was going up, strong sign. However, right now I see a warning sign, and that's because price went up, spot bought, price went up, took out important liquidity, but since reaching that high right here, we can see that spot, the white line, has been strongly selling off, while the orange line is holding up, which to me is a sign that spot, so the true and genuine buying, is selling off, while the fake buying is selling off. So that's a clear divergence between the two, and that's a warning sign for me. So in this case, short term, I'm being cautious that we can see downside. Of course, it can also be the other way around, where we have a divergence where price is going down, while the perps, for example, so let's say, do we have an example? I don't have a clean example right here, but if perps are shorting, so they are more selling, the perp CVD is going down while spot is buying. That's actually a reversed situation of what we have now. Then that's a bullish sign. So to put it simple, you want to look for divergences and then see if the genuine buying, so the real buying, which is spot, diverges with the perps, which is the fake buying. That's the CVD, but the more important one, which I'm now going to show you, is the open interest. So open interest basically shows you the amount of open perpetual positions, or in easy words, how many longs and shorts are open in the market. And it's important to know that the open interest shows you, which is this graph right here, shows you how many positions are open, both longs and shorts, but not, you can't know which one of the two. That's really important. Why I use open interest is because open interest shows you the positioning in the market. So the more positioning there is in the market, the more people are having positions, which means that there are more opportunities for volatility. If the open interest is doing nothing, so let me oftentimes have the open interest in this box down here. If open interest is doing nothing, I can draw there, but then you can also expect little volatility. When volatility or the open interest is spiking up and a lot of people are taking positions, then you can expect to see volatility. So in that aspect, you can also filter on coins which have open interest increases to see where the volatility is, which can bring great trading opportunities. So it shows you the participation and the volatility. And there are a lot of misconceptions about open interest. So I want to quickly show you this graph. This is one I made, and it basically shows you that if price is going up and open interest is going up, a lot of people think that that is a bearish sign, or that you have to be careful when that happens. And that is partly true, but in essence, it's actually a very bullish sign. So if you have price going up together with open interest, what shows shows that? That shows that the market is supporting the move. So price is going up, people are opening long positions, which means that is strongly bullish because new buyers are entering and supporting the move that is going up. This is opposed to what a lot of people think, that it's bearish, but I will later go back into that. The same is true when price is going down and open interest is going up. That means that the market is moving lower and that the market participants are opening new short positions. So they are going into the same direction as the market, which shows that there's great momentum and the likelihood of the trend continuing lower is pretty high. On the other hand, if you have price going up but open interest is going down, that is a sign that the market participants are not supporting the move. So then you have to be a bit more careful, because oftentimes that can also be the reason that the market is going up, because shorts are closing. If shorts are closing, they have to buy back their positions, which is short-term buying pressure. But I also call that fake buying pressure, because it's like short covering. So it's not genuine buying, but it's forced buying. Same is true for price going down, open interest going down. Then that's not too bearish, because this real bearish case is that bears are opening positions in the bearish trend. But here price is going down, open interest is going down, which means that likely longs are closing their positions. So that is important. And what is really important, why I use open interest, is to see what happens at key points. So here we have, for example, a clean range. We have the range lows, we have the range highs, and then we have the sweep of the range lows. One quick thing I want to say is that oftentimes I get questions around it. I share these insights in the Discord server, so then you can get updates throughout the day based on this kind of information. And if you have questions, you can also always ask them there or ask them in the comments. To get further with the things I was explaining, is that at key inflection points, so either at the range highs or at the range lows, or at really important levels on the chart, I want to look what the open interest is doing. Let's say, as we know, the market participants often get overly excited at the range highs and get overly bearish at the range lows. So a great tool that I use for the open interest is to see if we are nearing such an important level, the highs or the lows, to see what open interest is doing. If I see that open interest is strongly rising while we are reaching the range lows, that can be a sign that people are shorting because they are bearish. So they are expecting the bearish trend to continue, while in most cases, if we are ranging, price will bounce from here. So if a lot of people are opening short positions here and the price does not move lower, then those short positions, which for example opened here, let's say price moves down here, and then during this move down, a lot of open interest get added. That was also the case. Then people are expecting the price to move lower. And here comes the trick in play, because if open interest strongly rises while price is moving down, that's a bearish sign, as I just showed here. Price down, open interest up, strong bearish. So then you know that a lot of bears are in the market. However, when you can use the data for a reversal play is when you move down, but instead of going lower, you go up. And then especially if you have confluence with the range low, for example, where you can expect a bounce, then all these people who have opened short positions in this leg, once price goes higher, let's say in this leg, people that have shorted down here are in a loss. And if they are too much in a loss, it can be that they have to close their position, which adds fuel to the buying pressure, and then price can move higher again. So you never want to bet against the open interest. So if at the highs it goes up, or at the lows it also rises, then you have to be careful, because a lot of people think it's going to the lows, open interest is going up, people are shorting the lows. That can be true, but oftentimes it can also be that price goes lower because so many people are betting on it, or like smart money is betting on it. However, the only thing you can watch it is if you see a lot of open interest get added at the lows, but price fails to break lower. If it fails to break lower and you get like a local break of structure back in your range, then it can be a nice indication that all these people that shorted down here are positioned in the wrong way, and then you can get an expansion back up to the highs. For these moves, you also want to look at the structure. So like right now, a lot of people say open interest going up strongly, that's a bearish sign. However, that's not a bearish sign, as I explained this just yet. Like we have a solid uptrend right here with higher lows and higher highs, and so price is going up and open interest is going up, which means that people are supporting the move, and smart money is supporting the move. And the only way that these people will get vulnerable is if price breaks structure. Where do we break structure? If we break cleanly below this level. So for now, there's nothing to worry about, because all these people are in longs, but they are probably comfy in their position because they expect a higher low for a higher high. The only way this can be bearish is, for example, if you are nearing the range highs and you go into it aggressively and a lot of open interest get added at this move, but instead of continuation, you break your uptrend. In that case, all the long positions at these highs, they are underwater, and then that can create a strong sell-off lower. So it's really important to know when to look at the data and where you want to see certain trading behavior. Are they shorting the lows? Are they longing the highs? Are they doing it at an inflection point or not? And then you can look for reversal plays. However, as said, oftentimes price and open interest going in line means that it's a strong move. So don't be misinformed about this data. And I hope it's now clear. If you have any questions or you like the video, leave a comment behind and also show a like. Then I can get more of these videos done. And I see you in the next video. Cheers.